everybody, in case you're living under a rock and you haven't heard, because we send out a few texts every once in a while, we are having a hackathon buying multifamily this week. I'm going to be honest, I wasn't sure what a hackathon is, and it's going to be amazing. We were working on the agenda today. I am like so excited. It's going to be amazing. I'm going to put in a sign up link in the chat here in just a second, but it's in Houston, Texas. It's an all-day event, and it goes everything from starting, looking at a deal, underwriting the deal, making offers. It's going to be an incredible day. We really hope that you can join us if at all possible. You're going to need to register on this link here that I'm going to put up in the chat right now. All right, next slide, please. So tonight, we're going to be doing educational. So tonight we're talking about our next case study, which we're all talking about the tsunami of debt that's coming due. It's going to be amazing. Don't forget, think massive, be massive, and take massive actions. Educational series. All right, so I want to make sure that we're clear. What we're presenting here is the opinions of the team of Massive Capital. We are not real estate financial advisors, lawyers, accountants, CPA, any of those things. We are a bunch of folks that are doing this on a regular basis, and we are sharing what we believe is to be the best knowledge that we have that we want to share with you so that you can learn along with us. All right, so I'm going to talk a little bit about what is Massive Capital. We're going to talk about, we have wrong title up there. Every once in a while we get a slide off there. So tonight again, tsunami of debt. It's the worst behind us, troubles ahead. Oh, I guess it is thing. I'm sorry. So we're a vertically integrated real estate company. We're owner operator for value add multifamily assets. Massive Capital specializes in ground up construction with retail flex space, industrial storage space, mixed use multifamily. Combined with our partners at Realty One, we have 42 years of combined experience. It's pretty amazing. Very exciting to be part of this amazing group. On the left-hand side, we're involved in equity, brokerage. Brokerage is on the triple net, which is the office, retail, those types of things, property management. We have development, both in construction and metal and wood. And we have the Massive Capital Masters. Our education program. We really spent a lot of energy in building this program. It's going to be amazing, so you're going to want to learn more about it. We're very heavily focused in the Texas market because that's where a lot of us live, but we do have assets in Denver, Colorado, North Carolina, Georgia, and we are looking at triple net locations in Tampa and Arizona. Realty One on the bottom there has a total of 290 million in annum, and we're finally updated here. We have 200 million. I got to tell you, it was super exciting to see that number change, to be part of that, to see the fact that Massive Capital in 2 years has taken down 15 acquisitions, and we have those numbers of under management been adding to the team. We have a lot of philosophy. Every 100 million, we add a group of team members, and a whole bunch have just been added in the last few weeks. Super exciting to be part of such this amazing growth. The team behind the team. So a lot of people there. It's getting bigger and bigger. Soon we're going to need 2 slide decks just for the team behind the team. We're honored tonight too, Maria, because it's spring break where she is. She gets to join us tonight. We always miss her so much. She's a huge part of our group. Jasmine is hanging out with Grant Cardone in Florida, and Brenda's here with us. We have Mike as well. And so you'll see a lot of the folks that you're dealing with on a regular basis here, including all the Realty One folks that have to do with the assets that we're building or managing on the triple net side. Our fearless leaders, Shirar, Sanjay, and Mike. I got to tell you, these guys, I don't know how they do it. It's like day and night. But the passion and the joy in what's happening, it's incredible. And then we have Bo Pat and Alexis on the Realty One side. And again, it's a great partnership because of complementary skills. They have skill sets that we don't have. They bring a lot to the table. We have skills that they don't have. They're our sister company. We're planning to do a lot more projects with them this year and next. So again, very exciting. So last 2 years, we closed 15 assets, getting so long, we can't put them all on the slide deck anymore. We have a couple of new construction pending, some LOIs pending in Dallas, San Antonio, and 3 of them in Houston right now. I think we had 6 LOIs out at the moment. Our deal in San Antonio is actually about 89% subscribed, so we still do have some room. I'm going to put a link in the chat if you want to learn some more information about the Horizon opportunity, but it's a great one with a 2.11 multiple of your money estimated in 5 years at 18% projected ROI. And this one does come with a 7% CRAP. So what this does is this put the investors first. So I want to make sure that you realize until you make a return of 7% cash on your money, the general partner team doesn't make any money. So we're super motivated to make sure you get there to create a win-win situation. And that's Sanjay getting the keys, by the way. It was pretty cool. It was a great day. Harris Ridge, actually, I'm sorry, folks, sold out. You missed it. It's going to be a great one. So stand by for our next opportunity. We did have a 1031 fallout. A lot of people don't know that you can actually 1031 into a syndication. And these folks, it was the first time doing it, got a little bit complicated, and they decided that they would move on, but it didn't matter. We managed to find some investors because this is a great opportunity. So stay tuned. We've got a couple of deals that we're working on right now, and we should have something to present to you very soon. It's interesting. It's asking me if I'm speaking Arabic. I've never had WhatsApp ask me any that. I must be really mumbling. I don't know what it is. All right. So I think, Mike, I'm going to take over this one as well, correct?
Yeah, go ahead, Trevor, if you're good with.
Awesome. All right. So massive capital partnership. We grow together as a team. So one of the things that we've been super excited about is our mastermind program is created with partners. Okay, yes, they're part of our mentorship program, but our goal is that they're partners. So we do a lot of land joint venture owners. So if you have some land and land in a A-class path of progress development area, we're interested in joining with you and creating a win-win situation. We've been able to take over a couple of construction projects and get them finished. If you need some help getting them to the finish line, go to the next one, Sanjay. Multifamily, obviously, it's where we are quite specialized, and a lot of us have grown up on. So we're involved in asset management. In a future presentation, we're going to be showing the back end system that we've created. We can take over complex projects that have a lot of CapEx, and we're also willing to offer credit enhancement. So if you have a deal, we've got to be friends with you, and you need somebody to come onto the deal to be a key principal, Massive Capital is considering those at this time. We have a new partner, Client Harbor. This is amazing. I need to get the link. I didn't save the link for Client Harbor in my chat.
We got the link for you. It'll be coming here.
Awesome, thank you. So
thanks, Trevor. And Trevor, you mentioned about everybody, Schreier, Sanjay, and I being like crazy day and night, man. You're like the nomad. You've been from Dallas to San Antonio doing property tours in a back and forth in the same day or day back to back days, and Vegas yesterday.
Yeah, I was actually in Las Vegas for 20 hours. And
well, that's what a lot of people do when they go to Vegas, Trevor. So welcome
yeah,
back.
so
And
I
thanks.
went to a great meetup that was there. I mean, it's amazing too. One of the gentlemen there that was presenting his story was so amazing. And he's one of the hosts of the meetup there. And literally in 1999,
Or sorry.
homeless crack addict on the street, and now is successful real estate entrepreneur. It was just so inspiring to be there. There was 55 folks. I talked about my journey there. Super exciting. So, and you can see now we have the chat link in there. So tonight, what you're all been wondering, tsunami of debt. What's going to happen? Who has a crystal ball? We hope Sanjay does. Go ahead.
I don't know if anybody has crystal ball, but short term and long term is always the key. So Schreier is still there. Schreier,
Yeah, I'm here.
okay. You want me to go through? You want to talk or
Okay.
want
I
to?
mean, hey, I can kick it off, I guess, whenever we go. So, just as a context, this slide, and as you know, me and Sanjay, we debate a lot about the macros, and everybody got their own opinion, and we are in that bucket as well. But at the same time, we are flexible. When information comes out to be different, we say, "Oops," we kind of make, we shift. On that note, next couple of slides will be kind of data heavy, and so we'll explain a little bit more context about what happened coming in 2024 and where is that debt coming in, how that's going to play out. Then at the very end, we'll kind of wrap that around what's our opinion and how we are planning on it from the massive side of it, right? So this is a total market size, which is the first thing is look at the highest level of the US. What is the total debt that is pending? So that's right here. You can take a look on the left-hand side. That gives you the graph, almost $1.2 trillion in 2 years. But then if you roll back in 2023 on it, it's almost $2 trillion, right? So $2 trillion of debt that has to go through the system and come out either healthy or unhealthy, right? So that's the process that we're starting off. That include all the asset classes, and all the debt type, and all inclusive, right? So it's a massive exercise that we have to go through. On the right hand side, since 2023, and as you know, we talked about in a 36-month window, it's $2 trillion. Number two, office foreclosures already started last year, and it is started to happen, right? 2023, we have seen loan default started in the multifamily, but it hasn't quite taken off as the office took off. One of the primary reasons that we believe that happened because on the, for the office category, there wasn't any coming back, which just didn't see economically how would that be ever a time where office will come back in a price. That view wasn't there. So the lenders, they took the shot and they said, done, give me my office back. And then I'll go back to the market. I'll take a haircut. I'll do the write-offs the same way. That's not the case for multifamily. We're seeing potentially down the way there could be a way of coming back, which is why it's not quite, it just didn't happen yet. So a lot of the loans that were due in 2023, it got pushed back to 2024. So coming into 2024, we had $700 billion, and then we have another, I think almost more than half of the loans got pushed back from last year to this year. So this year is almost $1 trillion all by itself this year, right? So, and now the question is, what's the size of multifamily from that $2 trillion we just talked about it? So that's a chart that we saw last year, Q4 2023, coming into 2024. Again, we went down from a big total to the multifamily side. And if you click it one more time, you'll see it's right around that 2024 this year. It's about $180 billion. Now, one thing to keep in mind, the slope of this dip, the amount of loans that are due 2024, 5, and 6, and 7, right? I drew the line a little bit more steeper so you get to see that coming into the COVID, we didn't have that much of a stiff. So market was growing at a decently healthy pace. And then when the COVID happened, it grew up, very abnormal pace, right? Which is why the total amount of loans that are due, it is very steep. So if you click one more time, Sanjay, you'll see that it's almost $1 trillion only in the multifamily in the next 5 years, which is a smaller subsection compared to the total loan. From there, if you scroll and if you go look at the, when it's coming due, we know. And if you look at those two that are blocked out, is that from the $1 billion, from the $1 trillion, it's roughly 50, 20, 30, but roughly looking at about 30, $35 billion are really in trouble. Their DSCR is less than 1 or less than 1.25. So they're not set for refi. It's about $80 billion around, so $75 billion at 1.25. I'll talk about that later. But just coming into 2024, we have that amount of money, almost $35 billion, are in real trouble, just at the purely from the cost perspective. Then the question is, where is that happening? As you can see, San Antonio, New York, and New Jersey area. Okay, so that's like a whole setup, right? Now the question, where is that happening? That's the San Antonio, New Jersey, and everything else. Where is Texas? Where is Sunbelt? So this is a chart that was this year from the Credit IQ that tells you that if you look at the x-axis, it is in $1 billion, how much money, and on the y-axis is the city, and then top down, right? The New York, most expensive area, lower quantity of assets, but larger pool. And you can see that in New York, that's where there. Sanjay, if you click it one more time. So that is there, and then Texas, right? Our good old Texas showed up twice, DFW and Houston, number 3 and number 9 in the multifamily maturity. Interesting part, if you look at it, about 14% of the loans that coming up due have less than 4% interest rate. So it is in a very tough bind for them, right? And if you step up a little bit more, about 30%, it's the cap rate less than 4%. It's a lot of Class A's and B's will be there. And the last one is the 18% of the maturing loan in the next 2 years have a cap rate between 4 and 5. So 3 and 4 are dangerous, right? And if somebody gets crossed in between 2 and a 3, it's a very rough spot. Not only you have 4% interest rate, but also you came in on a very low cap rate. So one of the things that we have talked about it before from the massive side up until about a quarter ago, we did not underwrite any loan assumption less than 4%. That was one of the reasons. A lot of people say, why? We said, look, coming into the game, we're going to pay a premium price because we're doing a loan assumption at a 4%. When we sell it, just imagine we're going to sell it 3 years from now. We're going to sell it at a high interest rate. If we were to do it, we pay a premium at a 4% coming in, then we have to sell it at a 5%. That means us as the team have to work for free to improve the NOI just to take a hit or make the asset sell. And then you have to work double to add value. So for us, even a lot of folks on the road and bought less than 4% loan assumption coming in, we stayed away from there. We said we want to pay as much as we can on the market side. So most of our deals that we have done, on almost all of our deals we have done, it's around a 5%, if not more, loan, which is also why massive side, we are bullish on a bridge debt, and then we underwrite the agency second, and we mix and match it up to see what the best way to park it. Interestingly, if you see one of the things that I saw there that showed up, it's in North Carolina. So that was an interesting point, okay? So if you go to next slide, so coming in, we have seen the overall, now we have seen the multifamily, now we're in 2024. So this is,
there's a couple of questions that may make sense to answer now than at the end. So one person said, what do you mean from loans from 23, pushing back from 23 to 24? I think that will help with some context. And then there was another question. One slide says 344 billion, another one said 400 billion held by banks.
Thank you. So I'll answer
this. People are paying attention, so I want to make sure, because those timely questions.
Okay, very good question. So think about, nothing happens instantaneously, right? If the loan is due and hypothetically 4th of April, the note is due, but if I'm doing it right, if I'm negotiating with the bank, I can delay an action on the loan, right? So in 2023, even though the loans were due, what happened? Bank says, you know what? I'm going to negotiate. I'm going to go back and forth. Maybe I'll do a modification. Or we said, hey, let's go continue negotiating, and something were to happen a year after. So let's say, I'll give an example. A good friend of mine, they're good operators. They have an asset in Austin area. The loan was called last year, and last year, November timeframe, they said, take my key. And then January said, go take my key unless you give me a rate modification. And now they finally negotiated down a loan which was due last year. So based on this chart, loan was in 2023, but by the time they got done, settled the modification and reset the terms of the loan, it was in 2024. So there is a push out from 3 to 4. So that's where a lot of the bulging happened, right? So a lot of the loans, they started working on 23. By the time they work the process, still negotiating, they're still in 24. So
Perfect, thank you.
that was one. And second one, go ahead, Sanjay.
I was just going to say the difference in 344 and 400 is this 344 is the part of 940 multifamily that is held by bank. And as you know, for multifamily, there's the agency option, so which is a big part for multifamily. And then the rest is held by banks and some other funds and securitized products. But for banks, for the office and other commercial, the agency is really not an option. So most of it is held by life cos and banks and stuff. So this 400 billion of office is a higher risk, which can impact this 344 of the multifamily also, right? So that's a kind of a cascading effect and kind of good to monitor that. Back to you, Shrav.
No, thank you. Really appreciate it. Now, a couple of things is not that we're not going to talk about since you're talking about here. So folks who work on the balance sheet side, long-term liability and the short-term liability. So more than 12 months, less than 12 months. So we're expecting a lot more financial high grading to happen or downgrading to happen right around Q3, Q4 this year, and that's going to get interesting. But on that note, we also track some of those banks, what the balance sheet look like, and both on the office exposure side and non-office. That gives us a flavor whether if any property goes back to them, will they be open to negotiating, right? So we made a couple of rounds, maybe 3 rounds, where we talked to the lender directly, and we made an offer, and we're seeing a change of tones. If the same bank, maybe Q3 last year when we went, they was like, no, talk to servicers. Now servicers went to market, they went to market, and the loan came back to the balance sheet of the bank. They're open to talk much more favorably than last year, right? So that has an impact on those negotiating type and the openness of bank to a potential offer, right? So very good question.
And there is one more question in there that's kind of timely too. Loans due wrapped around the buyer buying the property, one interest rate and then being a different rate. This instance causing owners to negotiate with the bank about interest rates. So there's a question there. And again,
that's a good question. I'll come back and touch it in about 3 slides down the way. It's a very good one, right? So so we talked about 23 coming in 24 and how the mindset is changing, and then what's going on in 24, right? This slide is from January on the top right from the Credit IQ, and on the multifamily side, you could see that last year coming in, we have default rate went up. Now, full disclaimer, the greens are greens. That's a relative comparison. It's not because 1.5 is low, but as you can see over time, the default rate is going up, right? So from last year, 22, coming into 23, you can see the whole slew of assets that's in the maturity default or some kind of a default. And then coming into 24, it went down a little bit, right? Now, if you go to the next slide, let me just click one time. Now, one more month. Now we are this at the same slide, one extra line. Left one has January 24, right one has February 24. It went up by 1 percentage point, right? So now you have to step back and take a look at the whole segment of what is going on from all the assets that came due on March last year up until now, and the more coming through. And that's the stack up on top of the current loan that's coming up due, right? So that's where when we say the debt wall is real, the phasing is real, and now we have to go through the system and either renegotiate or do something as we kind of go. And that's the setup, right? And please start dropping questions as you go, and then we kind of go, right? So imagine we have the whole bunch of assets. They are just because of the interest rate, we're stuck. And now the gotchas, right? Now the question is, whoever went down, the assets went down, they're gonna come back, right? Now, in between the rate changes, what happened? The NOI erosion happened. Insurance went up, tax went up, overhead went up, just like our grocery went up, everything went up. So now that's a site, right? So another way, we could do the business plan. We have finished the CapEx, hypothetically, we have done the delivery, but based on things that are not in our control, insurance and the utilities and or the property taxes, our value went up. So not only my NOI went down, at the same time my debt payment went up, right? So qualitatively, or if I have to say it in a simple term, Sanjay, if you click it one time, sorry, I added a bunch of animation today. Rent went up a tad bit, cost went up quite a bit, NOI went down quite a bit. Now on top of that, debt payment went up a whole lot. So my cash flow took a major hit. And then loan is due, here comes the valuation. What do I do, right? So that's the drama, right? Nothing is getting better at this point. We just have to survive for a little bit. So that's the drama, right? So on the sell side, that's what is building up, and this is where we at. Now the question is what's going to happen on the on the buy side, right? How a system is going to take that whole almost $1 trillion assets to go through, right? Okay, so here we go. Now on the equity side. So coming in to 24, and so we saw that there's quite a bit of dry powder that's there, quite a bit of dry powder. And so we have, folks have money and they raised the fund and they're waiting on it. So last year, some of you guys may have heard what we saw is that, hey, market is very emotional. On top of that, there's unemotional money, and that unemotional money have a lot of long-term view than we do, right? I would say as a sample case, go talk to a broker and look at the age of the broker that you talk to on the multifamily side. And you will see how young they are, how old they are. There's not that many people have been in the game more than 5-6 years. So they don't have the view. So for us, again, going back, we want to stay close to the market. We want to stay close to the big shops. So look at it. So the big shops raised money. They have the dry powder and they're waiting. And what's happening on the back end, if a deal comes in where the retail equity is not available, they're coming in and buying it. And also for that note, they buy class Bs, class As, not a whole lot of class Cs on the institutional side. So whatever's coming up on a vintage wise, a good newer build product, it's being the transaction's been happening. So again, we're looking for an equilibrium when that's going to happen, right? Because as you know, everybody's thinking about where is the gap, where is the arbitrage. So we're saying a long way that, hey, we have a lot of loans coming due, which is true, but we also have a lot of money on the sideline. And now we're at the cross section, right? Okay, so on that note, we underwrite quite heavily. We engage a lot. So I'll give you 3 views of what we're seeing in between. On the lender side, they're not pushing to servicers unless they have to. We have seen quite a bit of loans being pushed to servicers last year. They didn't negotiate, but now they're negotiating. They are negotiating with current borrowers quite a bit. And the common trend that we see, they split. They are resetting the existing loan into a lower amount and then taking that chunk and putting it to other account. What I meant to say, let's say example, the loan is a $30 million loan today, and the loan is at default. And maybe the true value of the property is 25 million. So what they will say, hey, let me reset the loan at a 25 million, pay you interest on that one. And I take the $5 million and that's I owe you a check. At the tail end of it, when you sell the property, give me my $5 million back, right? So we're seeing that quite a bit. They're open to sell at a loan value. We get quite a bit of things that, hey, if I want to buy the property at loan value, but sometimes, most of the time, property doesn't work at loan value. And then they're retailing the capex draw. That's putting a huge burden on that, right? And then, on the other side, they're also taking notes for the operators who aren't cooperating or they're not good in communicating. And so you see, and they're anxious about their blacklist per se. So it wasn't all that there, but now they're there and they're checking everything. And for us, we have done quite a bit of deals, and we know friends who have done more deals than us. We're seeing the intensity of the auditing, intensity of the questions, and also if a borrower negotiating on the rates on somebody, they're taking notes. Okay, next time when you come back out, that may not be the same place, right? So that's taking notes. So let's say hypothetically, I'm a lender, right? And Ruth, you were a borrower. And the last thing I want to do, and I want to go retrade a loan product I already sold in the market. That's because I'm trying to save this project. look good on my end and also look good on your end. So I'm taking notes as a lender that, hey, I'm going to put you on a special list. So when I go through this one, next time you come back for a loan, I'm going to treat you the same way I treated you before. That's the note. On the operator side, I have seen, I mean, it is so humbling that how many, across the community, almost everybody, whoever has it, they're injecting working capital from their own pockets. Sometimes they just don't. And also sometimes, I mean, we have seen heavy-handed negotiating, heavy-handed that, lenders are lenders, right? We had a pulse of 7 and 8, what happened? So now that changed a little bit. It's before, lenders will say, give me my money, but now what we're seeing is I'll go default first because I know a lender cannot do anything with it because market is shut either way. And then I'll come back and negotiate. And that's an interesting mentality, but it is working out. And a lot of the folks are doing it now. I believe there's a long-term consequence to it, but take one day at a time, I guess. So it's negotiating with the lender to open up room for insurance cost. We have done one where the lender is asking for a AAA rating insurance company. And up until last year, they held strong with it, but that impacted our asset by about almost $80,000 rate increase. We won back and they took a deviation out for this year, gave us the money back. And so we are working on. And so let her understand, right? So again, and we see sponsors working with other sponsors to identify a way to trade the property to save as much as we can on the LP money. So everybody's trying, right? And we have last but not the buyers of the new capital. They're underwriting at 18 IRR. And 15, 17 are gone. I haven't seen it for a long time now. Long time will be next 6 to 7 months. Larger pref is around 15 IRR plus fees. And there's quite a bit of that. And after the fees and everything else, that goes to 18 IRR. And once you hit that 17, 18 IRR for the pref, LP's got to get 2 or 3% more. And then project has to be in a higher IRR. So that really puts the valuation in a very, lower mode. Very limited activity in the Class C. If you ask me, finally, all the new operators and us, we realized the definition of risk. Class B and a Class C did not have a price difference. Now they do. And again, it came with the price, but it is interesting to see very limited activity in the Class C. That has a couple of reasons because costs went up dramatically there. And the economic pressure or the earning power for the Class C tenants are real. And then also, the amount of equity you have to raise to buy an asset today is very high. So Class Cs are in a very tough spot. Institutional checks are buying out other parties at zero value. That is a very interesting play. Number 4 is institutional buyers. So I talked to a partner yesterday. They have a $90 million deal. The institutional partner brought about $15 million check. They raised $8 million. It doesn't refi. It's in default. Institutional check said, you go out, I'll buy you out at a 0. So they're saving the project, but the LP is getting wiped off on the retail side. The funds are back in action and very active. I had 2 calls today. 2 offices from 2 small family offices. No, not small, a couple $100 million worth of equity that they deploy. They are bullish. So they're looking at assets as you go. And in general, offers are low and not going up a whole lot because of the amount of raise and limited access to retail equity. But overall, there was a typo, but overall, even the project level returns are a tad bit higher or same as last year. The fundamentals of all the projects have become better across the board. It's that I flipped 2 houses. Now I come back, buy 100 units apartment. Those set of community, they understood the differences. The crazy assumption that, and some of us, we made 20%, 30% rent increase, they all got tapered out. So what happened is, even though you're buying a tight project today, the assumptions are strong. They're much closer to reality. So whoever can take down a project today, you're setting the project up for a strong value add down the way. So that's the takeaway, the last line. All right, so what should we do in 2024, right? If you ask us, so what are we doing? So we're running 3 scenarios, right? The first scenario that, Sanjay, if you click it one more time. So in our mind, we're running scenario, what we do. So first scenario is all hell will break loose. Another typo, sorry. All hell will break loose. Everything will crumble down. For us, it is very unlikely will happen. survive till 2025. It's now extend and pretend. Going back, everybody wants to kick the can down the way and get to a place where interest rate will drop, things will settle, and whoever is buying whatever way you're buying time. So extend and pretend is the thing. The same for the bank. Bank gets to say, I have a loan. I don't look ugly in the balance sheet. Operators get to say, I am surviving for another day. Hopefully market will turn and then I'll refi, get the money out. So I'm not in a, even though I'm in a loss position today, I'm not an absolute loss position because I walked away from the project. I'm still working for free, but potentially if the market turns, I can give some money back to the LPs, right? So extend and pretend is the new one. Second scenario, storm is here and it's a heavy rain for 24-25, which is our belief that loans, nothing's gonna break, it's not gonna break loose everything. It's not gonna collapse. It's gonna be a trickle down from now till 25. Supply will be very close to demand, and assets are, assets that are priced to sell, they will sell, and the economy will weather the storm. So it's not, we're not in a framework where, oh, I'm gonna get a heavy discount and that's the best deal. That's not. The way we want you to, I would say reframe it is true. If we bought something for $20 million 2 years ago, with keeping everything the same, just because the interest rate changed, it's about $70 million, $80 million price today, right? So interest rate will give you a discount in 2 years, but it's not a really discount. It's like a price, market price. So for us, the demand is there. As we talked about, the money is available on the institutional side, and assets are coming in a trickle down phases. So we believe market is in a decent place where assets are priced to sell, they will sell. And the third scenario we're running, all things will be better in 2025 all of a sudden. We don't see that happening right away. It's a slow wave that's gonna go through. It is very unlikely, at least for us as well. And so again, just the sheer amount of debt that is outstanding, we cannot correct it in the next 8 months. We just can't. It's just gonna take your time as you're gonna go through. So we're in the middle case, and so if we are the way we're talking to us, I mean, telling ourselves and also talking to investors is be active, don't be gun shy. It is okay if you invest the last 2-3 years and there are some projects, you are taking a hit just like everybody else, but if you stop, then you have an absolute stop. You don't have a way to come back, right? So continue investing as you go through. So we always can, invest our way out. We're giving ourselves flexibility. So return is there. So as an aggregate, you're gonna be in a net positive mode, not gonna be a net negative mode, right? So invest. And last but not the least, think long term. This is the cool slide that CRE and they posted I think a couple of days ago. I loved it. So it is one of the coolest things. Look at the left side. Us as investor, we got in the rhythm of, if you ask me, flipping a house, right? It's statistically what we saw is that if you buy anything, less than $500,000, you can be in and out in 9 months. Anything above a $1.5 million to $3 million, it takes about 1.5 years to turn and go. Anything above a $5 million, it takes about 3 years. Over 20, it takes about 5 years, right? There's a lot where we got there. Whole idea is that multifamily is not a house flipping business that you come in today and you sell it tomorrow. It's an operational business. So folks who came into the game, even the market is tough with a long-term view, and they're always there, right? This is one of the beautiful slides that you have seen, right? Retail slide, who had a bridge debt, they're in a tough spot. Who has a 5 years maturity, you're in a decent spot. But if you came in with the 10 years, 7 years, for whatever reason, you were in a good spot, even though you're taking a beating today, right? We have an asset, McCollum, and that was a highly levered coming in on the, like at the cusp of going up and down. When we saw it, it was a 7 years fixed, very low interest rate, we levered up high. So we knew we got the money for very cheap. Whatever happens, we have room to go through that. And that is paying dividend today. So, and the last one is my tagline, you invest, don't stop. If you're comfortable, if you're not comfortable, if you're scared, fine. But don't invest in a smaller chunk, but keep deploying your investment and keep rolling it, don't stop. Then you'll be in absolute stop, not being able to recoup whatever happened in the last 2 years, right? It was a lot, and I know I went through rather quick. So this is the last one on the slide. So I'll stop, open for questions, comments.
Schreier, thank you. Great. Beautiful presentation tonight. Thank you on that. And so many comments going on in the chat here that we'll get to. And as you catch up and catch your breath a little bit as you ran through all that. One thing I wanted to ask, and everybody knows, hey, we run a bunch of polls, and I promise next week we will have a new set of polls, and it'll be different. But the one thing with the polls is it does help us to look at what we're presenting and how we can continue to be of value to the community. So we really, really do appreciate the input and the feedback to the polls. And also, if you guys like this and you want to see more of this, I'm going to post right now in the chat. It's probably been there a few times, but we will be having an event in Houston this Friday again. You saw it at the beginning. If you want to see more, learn more, meet up with Sanjay, Shrier, and the rest of the team. Come to the hackathon live in Houston. It's all day. Going to be working on doing a multifamily deal in a day there. And, so you'll get to see and hear and learn a lot more of everything that's been going on this webinar and the others as well. So come and join us. It'd be great to have y'all at that. So I put in there was an Eventbrite code or in the link, so you can take a look there. And I'm going to turn it back over to Sanjay and Shrier and take a look through the chat. There were so many different comments, and you guys maybe had a chance to catch up while I was sharing here a little bit and read some of those and give some feedback. We're not really using Q&A, but also if anybody wants to just share or talk, just raise your hand, bring you up, and let's have a conversation.
And we do have a guest on this
Yeah.
Wednesday night webinar that I think he knows a little bit about that, Mr. Paul Peoples. He put in a couple of comments in the chat, so we appreciate that. It's always great when you get folks that do this for a living that show up and can add some value.
Let me do a quick shout out to Paul. Right, Paul has been a great wisdom for us. I mean, he's one of the best. I mean, he's one of the most, I would say, logical and unemotional person has been there, who's gonna guide you through every single process. And every time I needed something, I called him. He was there for me. So, Paul, we appreciate you being a good friend of ours throughout the whole journey. I think Paul have seen me the entirety up until today. So Paul, thank you for everything, and I would appreciate you joining as well. And for everybody here, if you want someone on your side who has been through cycle and stayed long enough, is Paul. I mean, trust me. I mean, we're not massive. Is a young car, relatively very young car, has a lot of mileage on it, but still, you go look at the brokers. Just look at the broker shop and say who has been there 8 years before that. Not a whole lot. Who has been to 7, 8 times, not a whole lot. And Paul is one of them. The Old Capital does extremely, their podcast is one of the best. I'll tell you one story real quick. Before I came into multifamily, I was like, I want to know. So what happened? I feel like in about 2 months, I had a long drive. I finished about 2.5 years of podcast in less than 2 months. So I knew how James came into the game, how Paulie came into the whole thing, how they have changed the whole thing. So Old Capital Podcast, one of the best podcasts you can find. Paul is right there. Reach out to him if you need guidance. He's one of the most level-headed person that I know. So Paul,
and I'm telling you, Brenda's our ringer. We're coming to your pickleball tournament.
Yes.
And we've got Brenda on our team. We're trying to convince Sanjay to play with her, but I don't know if he's gonna, but we're coming there. It's gonna be a great event. All the proceeds go to a charity. So it's always great when you can do that.
That's great. Thanks for
I
talking
am
about
there.
that.
Sorry, go ahead, Paul.
No, thanks for mentioning that. We appreciate that. Again, oldcapitalpodcast.com. And so we'd love to have you give a listen to. Again, we appreciate the shout out. I've been doing this for 38 years in commercial real estate banking. So I've seen a couple cycles or two. I kind of know where all the bodies are buried. I kind of understand a little bit about what's going on today. It's a very difficult time, but I thought Shrier did a great job of explaining it. And you're in good hands with the team over at Massive Capital.
Well, thank you.
Thank you, Paul. That means a lot coming from you. And Trevor, I was gonna say I'm by default there for the pickleball. If somebody from Massive, somebody else from the team wants to take over, they're welcome to. But otherwise, I'll be there by default. I haven't started training yet, but I will.
Now back to this hackathon, just to let you guys know. So Massive has a problem. We work a little bit extra and we get kind of intense. We get kind of intense when it comes to underwriting and things like that. So what we saw is, yes, absolutely agree. The YouTube University is real, right? You can go through it, the whole thing. But at the same time, it's an experience, right? It's an experience to call a broker. It's an experience to draft an LOI. It's an experience to negotiate a PSA. And it's an experience that it's tough to explain, right? When you send a $20 million LOI out, and your lack of better words, you're asking for that, you're waiting for the phone call and the oh shit moment, right? And there's a lot that goes into the preparation of that LOI. So we thought, you know what, we'll hack it. And we're gonna bring everybody into our shoes and run through the whole thing in one day. So go through the exercise of it. Just like you're going to B school immersion, we gave you the concept for 10 minutes, then we gave you the the worksheets and you work, and then we go to the next phase. So I mean, we are very excited about it. It's different,
Yeah.
but we're really excited about it.
Everybody who's gonna attend this, we're gonna make you work hard. What Shrai said, the problem we have is real because I start early, Schreier and Mike stop late. That means we're on always, and you know that's because not because we have to, but because we want to, and it's fun. It's fun, right? So it's hands-on. You know, looking up the deal, calling the broker, talking to them, what to say, and what you're saying versus what somebody on the next table may be saying, and then looking at the deal, writing that LOI, what to look, right? It's the real. You can learn the theory a lot of places. It's very good information out there. Anything that better than we can produce, right? It's a lot out there. But that hands-on, holding the hand and walking through the whole process to PSA, that's what we're gonna do here. That's why it's a long day. We'll have some food, snacks, a lot of coffee to stay awake, but we're really looking forward to it, and we're gonna. We hope it's a lot of fun. We're gonna have fun, and I hope everybody else have fun too.
Awesome. I was scanning through and I think we got the questions. There was a lot of chatter, and so if I missed your question, please raise your hand or repost it.
Couple question. These Wednesday presentations are recorded and we posted on YouTube and through our website. You can get to it. The hackathon, I'm not sure because we're doing so much hands-on and off the screen, talking in different areas of that big room. So I don't think we have a live casting available or a recording, but we're gonna repeat this year, right? We're just getting started on this. This is a unique, right? We think it's really unique in the multifamily space. Nobody ever has done this, in our opinion, or what I've seen. So we're really bringing the real work there. So we're gonna repeat this, but you know, nothing like the first time. So, but hoping to bring to other cities also soon.
Awesome. Maybe we could stop sharing so we can see everybody here. Awesome. What a great looking group.
By the way, in about 3-4 minutes, we'll turn off the video. So every questions, all questions are welcome.
Recording.
Yes,
So then,
recording, not video, my bad.
Yeah, anything goes after 7.
Anything goes after 7.
Anybody else have any questions?
But
Again,
where's
we
Paul?
always appreciate, there was a lot of info today.
Hey, I want to know what Paul thinks about that. I know I babbled my way through, but Paul, what is your opinion for next? I don't know. So what's your opinion? I just want to know from your perspective.
I think there's going to be a lot more opportunities coming up here. I think we're seeing the market itself. Like I put into the chat box, is that what has really had been a problem with the commercial real estate, especially multifamily is if you go back 2010, 11, 12, we did a lot of Fannie Mae business, and that was like 20 or 25% down. And a lot of people who bought multifamily properties during that period of time till maybe 2019, 2020, they made a ton of money. They made great returns on their money. Everything was coming up roses. And then in 2021, 2022, people wanted to get higher leverage. So instead of putting down 25 or 30 or 40%, because property values had gone up so much, they only wanted to put down 20 or 25%. And so they did these non-recourse bridge loans, and these loans were only good for, say, 3 years. So imagine, buying your house and only having 2 or 3 years before the maturity. But imagine buying a $20 million or $25 million piece of real estate and have a maturity coming up too quick. And interest rates had gone up, taxes had gone up, property has gone up, cap rates have gone up. And so you're seeing what the repercussions are right now. So these short-term maturities are killing the multifamily business, and we're going to see this huge amount of flush out that Cheshire was just talking about. We're going to see a lot of people that are going to lose a lot of properties. In fact, we saw 2 deals in Tarrant County courthouse that got foreclosed upon last month and actually went to a courthouse sale yesterday or the day before. So there is an opportunity to come in and try to buy these properties at a lower cost basis. They're going to be it's going to be reshook the market, and you're going to be able to buy these properties at a much lower cost basis. So I think that's what the future is going to be. And then, as I said, don't go to do these short-term loans. Do a 5, 7, 10, or 12-year term. And I just know that I've been in banking for a long period of time. The long-term maturities will save people. The short-term maturities will kill people. And that's what a lot of these people who did these short-term loans are finding out. They thought they would be smart, but because everything was going up, but it turned out to be the worst investment they could do.
Yeah, there's a good question on the expectations of how willing sellers are to sell. At some point, they'll have no choice.
Absolutely.
And which is the big difference.
And that's what we're seeing right now is there's a big delta between what a buyer wants to pay for and what a seller wants to sell at. So we're not seeing a lot of trades in the B minus, C plus, C properties. We're just not seeing it. We're going to start seeing a lot. It's going to be the edge is going to come off, and we're going to hit those things. And so we're seeing that right now. A lot of people are starting to default on those loans because there's not enough money in the operating accounts, and so they ask for capital calls to try to bring the money back in. And people just don't have any money. And so I would also tell you that the lenders are not going to deviate. They are not going to. They know what they have. If you don't have any money and you cannot make payments, they're going to grab the property and they're going to operate the properties. And the other thing is that we're not seeing a lot of the brokers be able to sell these properties. It's really the servicers, the lenders are going out there and they're trying to sell the properties direct to better operators like Massive Capital to be able to sell it to them at either the loan amount or maybe just below loan amount. They're looking for people that have money. And a lot of these ownership groups that were formed 2-3 years ago, they're out of money. And this is where, Sanjay and Mike and you, Trevor, and Sure, that's where your competitive advantage is. You'll buy these deals because the servicers are looking for you to operate these deals.
I mean, what Paul's saying is real. We talk to servicers, we talk to loan managers. I mean, when a property comes about, we track a lot of debt data, right? And then we'll call the lenders. We have some line of, some communication with some of the lenders. They'll call the asset managers. Asset manager will sign an NDA. We'll get some back-end information and we'll go negotiate on it, right? So what Paul was talking about, it is real. They are looking at stuff actively, and everything what he said, it is real. We see it, right? And especially the Class A, it's tough. It is tough on a Class A. It was hot potato back then. It went up. But now it's the hot potato nobody wants to touch, right? It's the other way around. But for us, again, our role is that we want to make sound decision based on the information that we have. At the same time, we are looking for a value add creation, right? We don't have to follow the crowd. We are okay to be a contrarian thinker and go where the margin at, right? So on that side, depending on the time and the place, If a C makes sense, we'll do it. But now we're also pushing up a little bit more. So we don't want to, we are not gun shy on a C at all, but there's some Cs we don't touch. All bills paid, no go for us. Coastal line, no go for us. Flat roof, not today, right? Have enough of a gunshot, right? So
Oh, yeah.
it just, there's some Cs not today, like for sure not today. So.
And that has expanded so much in the cap rates. Right now, C properties that were, so back, if we went back about 3, 4 years ago, cap rates on A, B, and C properties were all about 4.5, 5 caps.
That's right.
Today, A properties are maybe about 5 or so, 4 3/4 to 5. B properties are probably 6. C properties are 7+ in terms of cap rates. And right now, you know, to buy a property, do a Fannie Mae transaction, Fannie Mae rates are about 5.5, 6%. So you're going to have negative leverage just going in to buy a brand new Class A property. So how long can you keep, make payments where your interest rate is higher than what your cash flow really is?
Thank you, Paul. And now there was a question on it's how you feel about taking a bridge debt now. Massive is clear. It's we want to pay closer to the market.
So
And
I don't have a problem with bridge loans. I do have a little bit of a problem with adjustable rate bridge loans. So if we can
That's right.
do a fixed rate bridge loans that we kind of know what we're getting right from the beginning, and we don't have to pay for an interest rate cap. So I don't have to come up with another, what's funny is that we did these adjustable rates back three years ago, and interest rates were pretty flat. They're right around about 5%, 4.5%, 5%. And then all of a sudden they went up tremendously. But before they went up, you could buy an insurance policy to keep your interest rate low. And they were about $50,000 for maybe a $10 million. Today, because the interest rates have gone up so much, it's like almost $2 million to pay for an insurance policy. So it's crazy. So if we can get a fixed rate for say 3 years, and there are fixed rate bridge loans out there, that's the way I would tell you to take a look at that.
100%. We're bullish. We're extremely bullish. And any time a deal that it's broken or it's not stabilized and it fits into bridge, we got super excited about it. So I saw a report on NMHC coming out that said almost 60-70% of the folks underwrite first on the agency and about 20-25% underwrite on the bridge. It was like, yes, we're not the only crazy ones, right? It just makes sense to underwrite on the bridge first and then, but not a variable bridge. Fixed bridge, you come in, you do your job, and you get out. That puts you on a better place and a 3 to 5 years exit. But whatever happens, it's not going to be as crazy as today, right?
Yeah,
If you can make the right assumption.
We don't want to see anybody lose any money. So make sure that you discuss with your guys about how to structure these deals correctly. You want to have enough time, enough maturity that in case something does happen, that we have a downflow with higher interest rates, or we have taxes that go higher, that you have enough time to save the deal. And that's what really
Yes.
I want to stress
100%.
is longer maturities. That's how you make money in these in real estate for as long as possible. Hold these deals now for another 10, 20 years. Now, if you want to trade them after 3 years or 2 years, whenever you hit your business plan, that's fine. But make sure that in case something does go wrong, that you have this long maturity.
100%. And translate it from the regular term, the way we look at it, less than 150, you can have a sensitivity in 3 years. Anything above a 200 units and plus, there's no 3, it's 5. That ship is too big, it's too slow, it takes time. And depending on the size, we can decide the speed, right? Not everything is an 18-wheeler, not everything is a 4-wheeler, right? Everything got a time and a place for it. So Paul is what he's saying is right. And that's how we kind of match it as you go. And, then you make some assumptions and you talk to your folks who are looking over you and helping you out get to the right decision, right? Okay.
Hey, Paul, keep your phone on Friday while we're doing our hackathon. We may have some people calling you for some terms. We may need some shout out like, hey, what kind of terms you getting right now on this kind of a deal, since we're doing this thing live and making calls.
Yeah, we would be more than happy to help your team. If we could, so just let us know what we could do for you. Again, our group, we close 1 out of every 3 apartment loans in the Dallas, Fort Worth, Austin, San Antonio area. So we do a lot of business. So we may have more insight than most people do. So, but we do support Massive Capital and their team there.
It's not me. Paul has more insights. It's a statement, not an assumption. It's a statement.
Yeah.
So Jaden asked a question: is it possible to do 1031 into an? Okay, yeah. The answer is yes, you can. Again, I'm not an attorney or CPA. Talk to your folks, but it is possible to do take the the equity or the capital from the single family into multifamily. That's fine. And the paperwork is different. The way we structure it, it is different, but it is possible. We have done that before, so no issue on that one.
Yeah, you create two different entities.
That's correct.
Yeah.
So we do TIC model.
Yeah,
Tick model.
normally look for a minimum of $500,000 to $1 million on a 1031 to make the whole thing make sense.
That's right. So
Or
we have an
even
onboarding
more.
process now. Yeah, we need more. So Paul is right, but sometimes depending on the deal side, because we also do smaller deals in the new construction retail side around a 10 million each or so. So we may have room to bring you in. So we don't say, but on the larger deal, it needs some more money because it gets complicated and the legal and a bunch of other stuff. So it is there. Then where are you looking online to find the property was purchased in each MSA? Man, I don't know.
Oh, and hey, we forgot. I think Trevor shared it, but we forgot to mention Friday night also we're doing a meetup
Yes.
in Houston, and I'll share that link here again as well. That if you guys want to come to the meetup in Houston, come to the hackathon and then come to the meetup as well, or if you can't make the hackathon, at least come to the meetup later on that evening. Here's the link for that. Go ahead,
Mike,
Shreya.
thank you. It said, where are you finding the each MSA? So we don't look at it in a one way. So we follow. So we use Trap, we use Reonomy, we use CoStar. We have our own database, and we also underwrite a lot of assets. And once you underwrite a lot of assets, you collect a lot of T12s and a financial. You start getting a feel of the characteristics of that MSA. Then you talk, then people like Paul, so you kind of get everything all in to have an idea of what's going on where. But overall, we start with some analysis, like we'll go buy some data set and say, hey, let's look at the available debt that we have, and then we kind of go. And secondary is it's a semi-public information. If you have a deeper relationship with lending partners and stuff like that, reach out, and let them work with them to work with you, or you let them know what I'm looking for, and this is what I'm looking for. How can you help me, my team? One thing we say, you don't want to go to your team once you have a property under LOI or under contract. Because think about it, it just sounds silly, right? I want to build a winning team once I'm in the game and I got 90 minutes to go. How that's gonna play, right? Go practice outside, go build the team, go throw some balls and see how everything is run and practice, and then you do it. So build team in between the deals, raise money in between the deals. So when the time comes, who's doing what, right? So spend time with your lender, sit down, take them out. This is a good time, right? Everybody's trying to do something, and get those semi-public information, build your own database, then you're gonna go. Right?
Yeah, if I could just add one thing, there was a question concerning looking for information concerning purchased in an MSA, metropolitan statistical area. This is the same detail in terms of the purchaser. So in the state of Texas, we have a non-disclosure piece here. And so we really cannot tell you what the property sold for. You can see online through the every county typically can show you what the debt is against the property, whether it's a Fannie Mae loan or if it's a bridge loan. You can see what the loan balance is on the property, but we cannot tell you what the property traded for. And if we have insider information, and we usually do on all these properties, we can kind of whisper what that deal traded for. But things that the guys have, they have CoStar, they have Trep, they can kind of give you inside information on how the property is performing. We have that database too. So if there's anything that comes up that you guys want to find out more information about how the property that maybe have been built 5 years ago or 10 years ago or 20 years ago, we have great data, just like Massive Capital has on a specific property. Another question that came up from Dan is, are life insurance companies who are lenders willing to offer more competitive terms than Fannie and Freddie? And the answer is not really. So a life insurance company is somebody that, again, collects money from premiums and that will take a risk. And so to pay for the risk, to pay a return, they will lend money in commercial real estate. Now, life insurance companies are usually very conservative lenders. So they're not going to do 75 or 80% leverage. They may do 50, 60, 65, maybe max. And you're going to find a lot more flexibility with the agency lenders than you are going to be with the insurance lenders. So we do like insurance lenders, but agencies have the full faith and credit of the US government, so they can try to bring those rates down even farther. And so we use insurance lenders for like that, Fannie Mae and Freddie Mac, they don't do industrial, they don't do office, they don't do retail. The only thing they do is residential. So they'll do student housing, they'll do senior housing, they'll do market rate housing like what you guys talk about here. But we'll use insurance lenders for other property types, but not typically multifamily.
Paul is absolutely correct. With the Realty One, we just did a refi, a $27 million refi. It was a life goal. And that was the new construction at the very tail end of the completion of it. So we did not get enough. Agency doesn't have a product like that. And other loan product didn't have that kind of a leverage. Lifeco is available, rate is a little bit higher, but it's a different type of product, right? It's not the multifamily. So that's it. That's an example right there. So
Awesome.
And
So
again,
this has been, whoops, sorry.
no, go ahead.
No, I was just gonna say, this has been awesome. If you've got some value from our Wednesday webinars, please invite a friend. Our goal is to create a community, to offer a place where we can explain what we think we see, we can communicate with our community. Remember, your network is your net worth, and you're gonna probably find your next partner on one of these calls. You're gonna learn a lot of information.